Alright guys, glad to have you on, but again today I am sorry, we're gonna record this one on a Thursday. I just frankly totally forgot to record this thing yesterday. But anyway, I mean, we don't necessarily need to have consistency on the time of recordings. All that matters in here is that you have weekly snapshots for more than a year now. If I remember correctly, we've started this thing for more than a year now, so you still have significant data points in here to backtrack. And remember, this is really much better to me than any track record or whatever shit like that. Just because in here you have more than just the trades and the outcomes. You've got the reasoning, the risk managing, you've got the psychological aspect of everything with every week data points. So very interesting. If you want to scroll back in time and have a look at all these decisions and how they've been plotted one after the other, always in their reference context back then. Remember, we recorded these things not knowing the future. So you've got an entire strategic plot of a flow strategy for now more than a year. And we're going to keep on doing this thing in the future. But I think the amount of strategic and trading information that's been released throughout that year is staggering. On top of this, as we're reaching some more, I would say, advanced maturity in this thing, it felt appropriate today to kind of just step back and talk about it, because some users have been pointing out some very interesting stuff, which I think need to be further discussed. So, and I would say I agree, frankly, with some of it. Some people say, well, Phil, maybe you just got this one wrong. That means H1 wasn't the reference time frame on the S&P 500. And you've mentioned yourself, I mean, that there was much more noise than it usually could be the case on the H1 time frame. We've seen and we've had a hard time navigating all those areas in here. You can scroll back in time and look at the March 2023 videos back then to figure it out, how all those signals invited me to be more cautious in terms of the risk taken, widen the stop losses and stuff like that. So this was definitely not an easy area to navigate through, okay? But still, what's really important out there is to say, well, isn't that a signal that the actual pattern was playing on the higher time frame, like the H4 time frame? Because frankly, we had all the elements to do so back then. I mean, if you have a look at it, this could definitely fulfill the gap of the first flow. That means we have context rising above the rising moving average, then we got somewhat of a third range boundary or double top between these things, and then we retrace. You would have been able to buy the moving average. You had volatility alerts saying maybe you could save some gas for eventually trying to catch up the Bollinger Band, which never got traded, by the way, if you can see that one. But that's really the way to go. And it would say buying the moving average out there and the Bollinger Band would have been much easier trades to handle than the lower time frames, very aggressive positions that we had back then. And therefore, this volatility that inherited on the lower time frames. I would frankly agree with that, okay? That means the second flow would have been very nicely played all over the place until, of course, we get the third range boundary in here for a nice and simple take profit. So afterwards, I mean, looking backward in time, okay, does this sequence makes a lot more sense? Because remember, the third flow always happens at the Bollinger Band. That means we would have made a perfect nice entry in here instead of my early entries on the H1 time frame, which nearly got stopped out. Frankly, didn't. But it really got close. It would have been a first buying entry in here, eventually a second attempt at the Bollinger Band in here, V-shape reversed, and we would be now trading for the final third flow. And I would frankly say, well, now looking at it, frankly, the structure is much easier to navigate in H4 time frame. It sounds a lot less noisy than what we've experienced throughout the last year. Everything is visible for you if you want to scroll back in time. All right? I do entirely agree with that assumption now. The only difference that these people mentioning that don't get is that it's always easier to review history when it's past. All right? But the thing is that, well, as we experienced that through time, we didn't really have those informations. There were future coming, and there's no way you would know about the future. So there's really one thing that you need to take out of this, is that if you try to remake history when it's done, it's always easier than trading it in real time. The difference is what's making you handle this in real time must be predictable. That means you need to have a set of rules that you're going to apply consistently over time, not trying to forecast the future, nor trying to find the best possible answer to the question of what's going to happen, but try to have a consistent decision-making process that seriously limit your ability to, I don't know, finger guess or whatever, okay? But don't ever reverse engineer something that already happened trying to find the best way to navigate it. That's just the worst thing to do, okay? The past is past. What matters is how would you have performed in this environment not knowing what was going to come. Okay, that's really the way to go. And remember, if you're following those weekly podcasts and stuff like that, we follow a set of guidelines, which clearly starts by saying, if you want to apply the flows trading strategy that I've told you, you need to have a low risk strategy 3 time frames above. That means for the H4 time frame, you would have required to be on a monthly context, which we clearly were not. Okay, even if we have a look in here at the SPX, okay, we were not in a bullish context in a monthly. Surely the context wasn't very far away, but we weren't there. So the answer to me has to be this, to say we had no way to know back then, and we simply couldn't perform the flow trade in the 4-hour time frame because we didn't have the box checked. One of these boxes to say, if you want to trade 4-hour flow sequence, you're gonna have to be in a monthly reference context, which we were not. So you had no other way but to say, I'm gonna take the only one that I have that suits these needs. This is the weekly chart, and therefore I'm going to trade my H1 reference time frame. Okay? Now, of course, reverse engineering everything might sound smart to say, well, of course, Phil, the most elegant way to navigate this thing, frankly, now that this is history, would have been 4-hour chart time frame. But now that you have that one in mind, let me be real clear. First of all, you had no reasons to know that. You would have to break rules back then to forecast this to happen. But most importantly, you have an entire year-long track record of this thing. Have I ever lost some money into this? No, I did not. All I had to suffer was seriously volatile markets. And we've seen those volatility alerts all over the place, okay? All the areas in which I had trouble figuring out perfect entries of some sort was all these areas where I had volatility alerts. And if you scroll back in time to all those charts, there were basically all these moments I was like, yeah, okay, you know what? I'm going to just write in the stop loss. I see that the market is noisy, can have multiple causes, but the only one that I can know and learn out of is to say, I'm still going to apply my rules. I'm just going to be just giving some slack to the market, cut some slack, okay? Just widen the stop losses. Instead of going more aggressive, I was going less aggressive and accepting more volatility in the market. That is what you'll learn when you get more mature at trading these contexts, okay? But last but not least, and very, very important in that, like, can you really future forecast? Against, you just take your rules and apply them as they are. Because the difference is, as I followed my rules and applied them as they were, okay, I was able to trade this area. I was also able to trade this area, if I remember correct. No, sorry, I traded this area and this one. I was also able to trade all this area, but terminated with a stop loss in here, if my memory is correct, because there was a third range boundary on the H1 time frame, so took my profits there. I was also able to trade this bearish flow. I missed this one for just a bit, okay? And that's really the way it went, okay? I also took some couple of trades, one there, and both of them have been taking profits somewhat in the middle of that range here. So all these trades were profitable. Now, if I did know the future, assume that, and I was trading the H4 time frame, I would have had a nice entry in here on the moving average. All these volatility boundaries means potentially I would have been able to catch this trade, but frankly, not an easy task. I think I would have been able to catch this one. Let me just put prices back. Okay, so maybe this I would be able to catch. That means, well, pretty much the same entry price. I would be able to trade this thing all the way up to there, okay? This third range boundary, so nice, perfect taking profits. Wouldn't have been able to counter trade there, and I would have made a bullish entry here and eventually there, and that means I would still be in this third flow now, okay? Now, try to see and compute in your head which one of these two strategies was the most rewarding. I mean, let me just change the colors, okay? That means I would have been traded that one very nicely, and I would still be into this nice trade now. And all the rest wouldn't have been traded, because remember, the first flow is never traded for you, okay? I would be doing all these trades in the H1 time frame, all successful, and remember, I can't create anything. This whole have been recorded and timestamped into YouTube. You have proof of all these trades, okay? So that's really, really, really the way it went. And frankly, I think I've traded this area, I guess. I don't remember, but I think there was a trade in here as well. Anyway, so here's really what this was all about, okay? Very, very important for you to figure that one out, okay? That is clearly what happened. Now, which of these strategies is the most profitable? Well, that's clearly, no questions asked, the H1 time frame. That means even if retroactively I would have traded differently on an easier path, like just reviewing the future, not knowing about it back then, well, clearly the H4 time frame would have been easier to navigate. Psychologically speaking, far less noise, much easier trade to handle and stuff like that. Yet, H1 time frame, which was the only time frame I was able to trade back then with the informations I had back then, would still be more profitable. For the simple reason that the stop losses on the H1 time frame are therefore tinier. I mean, remember, a stop loss on the H1 time frame is the size of the trend channel somewhat, but that H1 trend channel is much, much smaller in size than what would be the H4 reference, which means all those trades in the H4 time frame would probably have, I guess, somewhat like double their stop losses. An average H1 stop loss would be half the size of what it was for the H4 time frame. So surely the H4 time frame retroactively would have been easier to handle and for and just rewarding as well. But truth is, not knowing about it and still trading on the shorter time frame, which was more aggressive, much more noisy, and much more difficult to handle psychologically speaking, was still more profitable. So there's the second lesson to take out of this. Okay, so when you trade shorter time frames, it might be more difficult to handle, noisier and stuff like that. But so long as you gather these information and process your risk management accordingly, you're still going to be more profitable. So the lesson isn't just, okay, try to go on the lower time frame or whatever, just learn how to adjust your risk limitation. Because frankly speaking, okay, some of you guys have been trading these things as well, but as you did not modulate your risk management back then, some of you have been stopped right at the bottom in here, okay? That means you've taken losses where I did not, and this can clearly shift the overall outcome. That means if you did not adjust to these informations back then, and if you kept being very aggressive against the markets, well, you probably have taken some stop losses. You'd still be profitable overall, I guess. But frankly, the expectable returns will be severely diminished if you don't follow through with the risk limitation. And that's going to be today's very, very important knowledge and educational content. Say, gather those informations, okay? Anytime you trade, trade because of the rules you have. Just don't say, well, maybe it looks more appropriate to trade this on a different time frame because for whatever reason, the rules seems to play easier on these time frames, okay? Don't fall down this path. You're not looking for the easier stuff, okay? You're not looking at picking the market and pull it into your boxes. That's not how it goes. Remember, that's not what you do. What you do is that you have context boxes in which there are sets of rules, okay? In order to open each box, you need to fulfill some rules. They're all written down in the Prezi, okay? So you needed in your thing to have a low risk support area 3 time frames below. Did you have it in a monthly? No, you did not, so you couldn't trade 4 hour. Retroactively, it would seem more appropriate, but frankly, you couldn't know about it. So don't try to find the most suitable trading strategy for any environment. Just try to find the one that fits your rule and trade it. And sometimes, even though future will say it wasn't the most appropriate, you would still be profitable only if you are able to as well manage your risk. Remember that when you're not necessarily in the most suitable scenario, not the easiest one, you can still navigate it very efficiently. Just need to gather the information and risk manage. And the second part in here, as you would see, can set a significant difference between those who are able to manage their risk correctly, by gathering and adjusting their position sizing properly against those who won't. Probably I think everybody will be profitable there. It just means there are three classes. Those who will have broken the rules to say, okay, it looks better in 4 hour, I'm going to trade 4 hour. Well, good luck with that, because what you've just done is breaking the rules. You've just, yeah, this time around it went well for you. Actually, even better, because truth is the future gave you the positive answer. To say, yeah, you were right, frankly, I think, to trade it 4 hour, but you've broken some rules to get there. That means if you stop thinking about this particular trade, and if you extrapolate that to 50 other trades, the only thing that you've done is breaking some rules. And I can tell you one thing for sure, it's not going to be profitable over the 50 next trades. You need to follow these goddamn rules. If you stop breaking them for whatever reason, because you think the market fits more into this box rather than this one, by breaking rules to get there, that's not what you need to do. Second lesson, okay, sometimes you won't have the perfect answer, but if you still navigate correctly, you will be profitable. And third lesson, if you learn how to gather the market information and adjust accordingly as you go, you will be even more efficient. So that's the last thing. When you are getting familiar with those contexts and when you've traded them regularly, multiple times, this is how you get better at fine-tuning. Because fine-tuning is what makes the difference between someone who's just learning those flow sequences and someone who's been doing them for years. You will get to exactly the point where I am. The rules that I have used back then are not complicated. I just gathered market information, and instead of being more aggressive, which most of you guys fell for back then, you will learn to do the opposite way around. Okay? So that's really, really the three important takeaways for this week. Very quick, but still necessary look at the crypto ones. Okay? I'm just going to go daily chart in here so we get the full picture of it. So we're still the third floor, but remember, you don't really want to be jumping in the boat for cryptos now, but you don't want to exit too quick. You need to wait for third range boundaries. We still have no signs of it in Bitcoin, so let it play out, okay? We've already broken the previous high, so just let it play out. For Ethereum, we're still a bit younger. We haven't broken the previous high point yet. Still, people call it underperforming, whatever. Remember, you don't merely pay attention to these guys. All you need to know now is that the third floor will finally be confirmed when we finally break this area, and until we do, this is not a granted stuff. When we do, you will be able to put your stops at break even, breathe out, and just live it until it does a third range boundary as well. Okay, so that's really the way it goes. Until we got something, that means for now, bare minimum for the Ethereum chart would be to slow down and pull back down to 1800 to actually say, yeah, we get something that says potentially a third range boundary will come, okay, and a delayed one. But until then, so long as we don't even go context to context, well, there's nothing to talk about. We've let the bears an entire consecutive corrective cycle in here, and they didn't even manage to cross below 50%. So, frankly speaking, that's just a sign of strength. You can do whatever it is that you want. There's nothing supporting the bearish argument there but fantasies. So until we have something reliably going either sufficiently down to say, okay, we're nearing the end of it, all that we see here is just like Bitcoin did a few weeks before that, we see the context who is attempting to rise faster than the moving average. That means just probably a few weeks from now, we'll have it above the moving average. And remember, for the third flow, this is not a necessary mandatory stuff. The third flow doesn't necessarily require the context to cross over the moving average, but having it is therefore a sign of strength as well. So all that we see is, technically speaking, we're leaving some room for the bears, but they just simply can't score any significant points in there, not even managing to trade below the 50% context line. All I see here is just, yeah, it might be slower than you think because you want this thing to rise to the moon, but until then, it's just showing signs of strength instead of the opposite way around. So just try getting familiar with this. Do you even have a single in here volatility alert of some sort or whatever? No, you've got nothing, not even in the daily chart. So all I'm saying is, frankly, you have in here the opposite, okay? You've got a squeezing alert. That means the prices are not volatile enough. Expect them to be volatile at some point, but that's all you need to know. For now, the prices are moving slowly, and there's nothing you should do about it. The only thing you should be worried about are volatility alerts. In here, we've got the opposite. So all that you should learn out of it, okay, is to say, just like we've mentioned for the S&P 500, having the volatility alert says, okay, maybe I should widen my stop loss, accept volatility to emerge out of nowhere. That means I will be less acting against catalyst. I know that catalyst will move the prices more aggressively, and I need to get along with it. I need not to make to put my stop losses too close so that these events can take them down and put me out of the market. When on the opposite way around, in here the alert we have is the exact opposite of it. Is to say we have not enough volatility. That means the market is moving slower than what it's supposed to be doing. So get along with that. The market moves slower. Take that information for yourself. Does that mean you need to be more aggressive and anticipating the market will suddenly flush it all out and I'm going to lose all my gains for whatever reason? No, the answer is exactly the opposite out of there. The market is slow and you have all the evidence of it. So embrace that. Instead of getting more aggressive, expecting something shitty to fool out your gains, just understand that right here, the lesson is it's going to take longer than expected, folks. But embrace that. You have it all in front of you. It's not irrational. It's absolutely critically information that you can process. All right? You know what a squeeze is. That means the price doesn't move enough through time. It is just against the average. That means for now the volatility is lower than it would have expected to be in these contexts. But get along with it. Live with that. Remember, in flow sequence, anything that is suitable to time is none of your concern. That means we probably will still hit the same price areas as expected. We'll just do it slower. So get along with that. Okay? Though once again, very, very important. Today's lesson is don't try to put the market into your boxes. Use your box to see which kind of strategy you can use in the current market environment. Don't try to forecast the future. Don't try to find the best strategy. Just find the one you can use. Once you're into this, gather the informations. By gathering those information means even if you do not have the perfect strategy, you're probably going to be efficient anyway. Sometimes even more than the ones who break the rules to get the perfect strategy. The difference is if you do this, what you do actually is learning how to break rules, which is not going to be a sustainable way to make money in markets. You'd rather like to not have the perfect market situation, but trade it efficiently. Okay? That really is this week's lesson. That being said, I'm going to leave you guys with that to avoid a 30-minute long video. See you guys next week.